Hey, everybody. Okay, sorry for the delay. I was having some technical difficulties getting in to my own meeting that I set up, but I'm here now. So what we're going to do today is go over the quiz and go over the homework. And the exam is going to be a week from today, next Wednesday. So use this time to, after we've gone over the homework and the quiz, use this time to study the solutions to the homework and to the quiz. And also take a look at the study guide that I posted in Moodle. This afternoon, I'm going to be adding more details to that study guide. And it's very important for you not to miss class on Monday. We'll be face-to-face on Monday. It's the first face-to-face class since the storm, required face-to-face class. And we'll be going over, I'm going to spend the whole hour and a half going over a very detailed review for the exam. So definitely attend class on Monday. And so we'll spend that whole class time reviewing for the exam. I'll give you some hints. And you can bring a formula sheet in for the exam. Don't forget, 1 page front and back formula sheet. And if you know the material for the exam, you'll be fine. But it is about 36 multiple choice questions. It's easy to get confused, as you know, on these multiple choice questions if you don't know the answer. So the right answer should jump out at you if you've studied. And so I can't stress enough that you really need to study for this exam. And that's why I'm spending, with the storm and all, that's why I'm spending extra time, whole class period on a review. So you can bring in a calculator for the exam, and you can bring in a 1-page formula sheet, front and back, with formulas only. And so anyway, starting on Monday, you're required to come face-to-face to class. If you have extenuating circumstances, meaning you've had to leave the state because your house is uninhabitable, then let me know, and you got to get approval to not attend. So, so I expect hopefully to see everybody. Hopefully no one's in that situation for this class, and you'll be able to attend face-to-face for the rest of the semester. Okay, well, let me start by pulling up the quiz. So hang on a second, I'm going to share my screen. And I'm going to pull up the key to the quiz. Okay, so here you have, you had all this mixed up information, and you were supposed to prepare an income statement and a balance sheet using the above information. So of course, it was open book for you. For the exam, there's going to be some multiple choice questions about the income statement and the balance sheet. So you should read, there's conceptual questions, and then there's also computations regarding the income statement and the balance sheet. So read everything you can in the book about the balance sheet. For example, the balance sheet covers a snapshot in time, and just read all of the information about the balance sheet and what's contained in it, and as well as the income statement. The income statement covers a period of time for either a calendar year or a fiscal year. Okay, so anyway, for the quiz here, you had to create a balance sheet and an income statement using this information. So this is what you should have for your balance sheet. Your assets, your first asset is cash of $100. Marketable securities, that's also a current asset. Marketable securities is money in what we call a money market account. So it's like a checking account. That's money that is in short-term government debt instruments, short-term government bonds, and you earn a little bit more interest than you would on a checking account. So cash, marketable securities are just like cash. So you should have cash, then marketable securities, then accounts receivable for $500, then inventories. This is all your current assets: cash, marketable securities, accounts receivable, and inventories. So your total current assets, $1,500. Then the only long-term assets that we have is the net plant and equipment. So the net plant and equipment is $2,600. And so your total assets are $4,100. So you should have that's what you should have for your total assets, $4,100. Any questions so far? Okay, liabilities, accounts payable, $220, accruals, and notes payable. So this is what these three items make up your current liabilities: accounts payable, accruals, and notes payable. Current liabilities are $620. After that, we have long-term debt of $1,400. So the total liabilities are $2,020. Current liabilities plus long-term debt. Then we have our equity. So remember, on the left side of the balance sheet, you have your assets. On the right-hand side, you have liabilities and owner's equity. The owner's equity portion is common stock plus retained earnings. So that the total equity is $2,080. Add up the 220 plus the 280 and you get $4,100. And of course, your liabilities and owner's equity has to equal your assets. All right, so I'll post this on Moodle after class today. And so that's your, well, actually, I'm going to post this tomorrow because I still have someone who needs to take a makeup and turn into makeup. So, but this will be posted by tomorrow on Moodle, so you can look at it. Okay, so that's the balance sheet. Here's the income statement. Okay, so with your income statement, you have sales of $4,800 minus cost of goods sold. So your sales minus your cost of goods sold, then you subtract out your total operating expenses, subtract out depreciation, and you have earnings before interest and taxes of $2,000. Okay. Now you actually could have, hang on a second. Let me add this, whoops. Okay, so you could have had this subtotal in here. So in other words, your sales revenue minus your cost of goods sold minus your operating expenses. So any expenses that are associated with your sales, cost of goods sold and operating expenses, that you subtract that out from your sales and that equals EBITDA or EBITDA. Earnings before interest, taxes, depreciation, and amortization. So your EBITDA is $2,400. Then you subtract out depreciation. That gives you your, and you see we were just dropping off the depreciation here, depreciation and amortization. So we have 2,400, subtract out depreciation, and we get our operating income or our earnings before interest and taxes. That's 2,000. Then you should have subtracted out the interest. You get earnings before taxes of 1,850. Subtract out your taxes, 1,850 times 25% is 462.50, and you get your net income of 1,387.50. So that's your income statement. Any questions on that? Okay, so the bottom line then for your income statement, your net income should be 1,387.50, and your balance sheet, you should have gotten 4,100 for assets and liabilities and owner's equity. Okay.
I'm sorry for interrupting, but for net income, I rounded to the taxes. So I got like just the whole number instead of.
That's okay. If you round it up, that's fine. Okay, then you had to answer these questions. So what is the total common equity? Well, the total common equity is your retained earnings plus the common stock. So the equity is what the shareholders own. So after in a balance sheet, after the total liabilities, then you have the equity section, and that equals the common stock plus the retained earnings. Now let's go back up here and see what was not included in any of these. So if you look, dividends paid, there were dividends paid of $100. That's not included in the balance sheet or the income statement. That was just erroneous information. Because if you remember, once you get your net income, there's two things that a company does with their net income. They pay out dividends and the rest of it goes to retained earnings. But the dividends paid doesn't appear anywhere in the income statement because that's done after you get your net income. So that was the one thing, this dividends paid, that was the one thing that didn't fit in anywhere. All right, because here we've got the net income, and with this net income, they would pay out the $100 in dividends, the rest would go to retained earnings. But it's not gonna, that doesn't appear on the income statement. Okay, what's the current ratio? The current ratio is current assets divided by current liabilities. So your current ratio is going to be 1,500 divided by 620. And so that equals 2.42 times. Okay, so that means that they have enough, they have enough current assets to pay their current liabilities 2.42 times over. So they could pay their bills 2.42 times with that, with their current liabilities. Another way to think about it is that for every dollar in current liabilities, they have $2.42 in current assets. Okay, the quick ratio subtracts out inventories. It just gives us a more conservative approach because it just includes their most liquid assets. So the quick ratio is current liabilities minus inventories divided by, current assets minus inventories divided by current liabilities. And that's 1.29 times. So they have enough of their most liquid assets to pay their current liabilities 1.29 times over, or they have $1.29 in liquid assets for every dollar in current liabilities. All right, what is the debt to total capital ratio? Okay, so that is the total debt divided by the total capital. So the way you get that's 49.27%. So the total debt is current liabilities plus long-term debt. So if you take 1,400 plus 620, let me write this down, for 14 current liabilities plus the long-term debt. So 14, so that's, let me go back down here. And you're going to divide that by total capital invested, which is total debt plus total equity. So you're going to divide that by 620 plus 1,400 plus the total common equity, which is going to be 980 plus 1,100. So that should equal 0.4927.
These are total debt plus total equities.
Mhm.
But what about the long-term debt?
It's the long-term debt is the 1,400.
I thought you said for the total, total invested capital, it would be the notes payable plus the equity plus long-term debt.
Well, let me see if let me check this number because there's two different ways to do it. Sometimes they'll include the current liabilities plus long-term debt. Other times they just include the notes payable. Let me recalculate this number and I'll tell you in a minute. Just a second. Yeah, the way to calculate it, you should use the current liabilities. So current liabilities plus the long-term debt. If you did it the other way, it's fine. But you can do it, you can do it either way. But so the debt to total capital, sometimes they'll just use the notes payable plus the long-term debt. But other times they'll consider all the current liabilities as debt. So then it would be the current liabilities plus the long-term debt.
Just very confusing.
So for our purposes, let me label this for you. So you'll have this. So it's current liabilities plus long-term debt divided by current liabilities plus long-term debt plus common stock plus owner's equity. So if you didn't use the current liabilities, if you just use the notes payable, I'm not going to mark it wrong because it was a little confusing the way I explained it on Monday. As I said, sometimes people will calculate it that way. They'll just include the notes payable from the current liabilities. They won't include all the current liabilities. But then this is the more common way to do it. So do it this way.
So sometimes they're going to use just total debt, and total invested capital will be all current liabilities, long-term debt, and the equity. So basically all the total liabilities and total equity. And sometimes they'll just be so only cherry pick certain. It's just very
right. So, but just the total invested capital, current liabilities, plus long-term debt, plus the owner's equity. The debt is current liabilities plus the long-term debt. Okay, so you're taking the current liabilities plus the long-term debt. That's your debt. You're dividing it by the total invested capital, which is the current liabilities plus long-term debt, plus your owner's equity, which is the common stock plus the retained earnings. And so you should get 0.4927, which is 49.27%. So what does that mean? It means that 49% of their capital is coming from debt. Remember, there's two ways that a company gets money: debt and equity. They either issue bonds or get loans, or they issue common stock. So 49% of their funding is coming from debt. All right, and then the net profit margin is simply, that's going to be net income divided by sales. And so you take the net income, the bottom line, net income divided by sales, and you get their their net profit margin, which is 28.91%. And then the times interest earned, that's the interest payment divided by the earnings before interest and taxes. I'm sorry, it's EBIT divided by the interest payment. So if you take EBIT divided by the interest payment, you get 13.33 times. So that means that they are able to, they have enough earnings before interest and taxes to make their interest payments 13 times over. So the times interest earned is earnings before interest and taxes, EBIT, divided by the interest. So they're in good shape there. Okay, any questions on the quiz? Go ahead.
So I didn't see the net income thing. Like I just saw the debt to total capital ratio times interest earned, quick ratio, current ratio, but I don't see like the one you mentioned.
You don't have number 4 and 5 on the quiz?
I have times interest earned, but like when I found the copy on Moodle, it didn't have the net interest earned.
Oh, I'm sorry, I might have, this key I might have shortened the quiz. It didn't have net profit? Oh, it doesn't? Okay, so I just went from debt to capital to times interest earned? Okay, all right. So anyway, this is Lanyap. This shows you how to calculate the net profit margin. That I took that out of your quiz. That is net income divided by sales. So that's going to equal, what is our net income there? Net income is 1387.5 divided by sales of 4,800. And that should be 29%, 28.91%. Yeah. So that's how you would calculate the.
So I think I messed up because I forgot to do the second. I didn't realize that explain the meaning part of it.
Okay.
So I forgot to put that in the answer.
Okay.
How much like
Just a few points.
Okay.
It won't be much.
like even if it did happen for every answer?
Maybe 5 points off. Yeah, no more than 5 points. Okay, does anyone else have any questions? All right. Well, I'll post this tomorrow on Moodle. Okay, let's go to the homework. Okay, all right, I thought I had the solutions there, but I don't. Hang on 1 second. Pull these up. Okay, so we, let's see for. All right, so for homework 3, it was questions 1 through 8. So let's take a look at the questions first. Okay, so what four financial statements are contained in most annual reports? That's going to be the balance sheet, income statement, the statement of stockholders' equity, and the statement of cash flows. Now, for the exam, make sure that you read about each of those statements and can answer a few multiple choice concept questions about those statements. All right. Okay, then number two, bankers use, let's see. Number two is, what are some of the basic uses? Who are some of the basic users of financial statements and how do they use them? Well, bankers and investors look at them to see how the company is, how the company's doing, whether they're going to extend credit or whether you should invest in a company. Managers look at them to see how well they're doing. So, anyone who has an interest in the company or is interested in investing in the company would look at the financial statements to see how they're doing. Okay, and then number three, explain the following statement. Although the balance sheet can be thought of as a snapshot of a firm's financial position, the income statement reports on operations over a period of time. So yes. Oh, wait, I'm sorry, I was reading the wrong one. Number three, if a typical firm reports 20 million of retained earnings on the balance sheet, could its directors declare a $20 million cash dividend without having any qualms of what they were doing? Explain your answer. All right, so no, because remember that that retained earnings probably isn't all held in cash. And if theoretically, if they had 20 million in retained earnings, they could pay it all out in a dividend, but the retained earnings are supposed to be held on to the firm. The firm wants to hold on to those retained earnings to invest in future projects. It's a cushion, if you will, or to maybe expand and if they want to purchase some additional capital. So it really wouldn't be smart and wouldn't be thought of as being wise to pay out 20 million in dividends because they have 20 million in retained earnings. Okay, and then for number four, just make sure that you understand that for the balance sheet, they're showing at the end of the year what they have in, what are their assets, what's the value of the assets, what's the liabilities, and what's the owner's equity as of December 31st, say 2021. However, the income statement is showing what they sold over the year and what their expenses were over the year. So that's why a balance sheet is simply a snapshot in time, whereas the income statement shows what happened over the course of a calendar year or fiscal year. All right. So number five, financial statements are based on generally accepted accounting principles and audited by CPA firms. Do investors need to worry about the validity of those statements? No, typically they don't. That's if we've had some scandals in the past where there's been, like the Enron scandal, for example, about 20 years ago. That was a real problem, and a few other scandals. And so these auditors are supposed to be independent. We're supposed to be able to rely on these financial statements. And if we couldn't, then the market would crash. Nobody would invest in the market. So the Securities and Exchange Commission takes great care in making sure that everything is above board. Now, it's interesting that they have this question here because it makes me think of China. If you're an investor, you can invest in Chinese stocks. And one of the big problems with investing in Chinese stocks is that you can't rely on the financial statements. You cannot rely on these independent auditors. They don't have GAAP accounting and they don't have these independent auditors. Some of the larger companies do, but there's always this underlying problem that these Chinese companies aren't being above board in their financial statements. And that's been a big issue for the stocks. But anyway, with American companies, for the most part, you can rely on the financial statements. All right, number six. Oh, okay, you were supposed to read that at a glance, aggregate balance sheets and households, what has happened to net worth levels since the crisis. And, okay, so that's just, I'm not going to go over that other than just make sure you read that and kind of have an understanding of what happened. But of course, basically what happened was people lost a lot of money during the crisis of 2007 to 2008. They lost a lot of money in their stock accounts, in their retirement accounts, investment accounts, and they lost a lot of money in real estate. But since that, things have rebounded and improved, and people actually are wealthier now than before because the market's gone up by more, and so have property values. Okay.
Questions like that, like the story question would not be on the test?
That one's not. That's not going to be on the test. Okay, what is free cash flow? Let's see, 7. Free cash flow is cash flow that's available to investors. So after the company has purchased all of their capital equipment, after they've purchased any long-term assets, maybe increase their working capital, what's left over is the free cash flow, and that's what's available to investors. So free cash flow is important because it shows the amount of capital that would be available to investors. If you were an investor, why might you be more interested in free cash flow than net income? Okay, because remember, with an accrual system, net income doesn't mean that's the cash that they have on hand. Net income doesn't translate at all to cash. Free cash flow tells the investors how much cash is available to us. And then 8, would it be possible for a company to report negative free cash flow and still be highly valued by investors? Could it ever be viewed optimistically? Yes. So that was kind of what was happening with this company, this De Leon company that we saw in chapter 3 and chapter 4. Remember, they had that big project and their cash flow went negative. Their free cash flow was -2 when we calculated at the end of chapter 3. They had this big project, but then it turned around in chapter 4 and everything was good. So having negative free cash flow isn't always seen as a bad sign. And a lot of times it's seen as a positive sign, because what does it mean? It means that the company is investing in their future. They're investing in capital, they're investing in these projects, that should pay off. So if you see a pattern of negative free cash flow for several years, that's an issue. That would be viewed as negative. But if a company has taken on some big project and they have negative free cash flow for a year or two, that is not seen as negative and actually can be seen as a positive sign. Okay, any questions on the questions? Okay, so if you attended on Monday or watched the video, I gave you some hints on how to calculate these homework problems. So here's the solutions. So we went over in class, we went over how to set up this balance sheet. Now, you didn't have to set up this balance sheet for problem 1, but if you set this up, using the information that was given in the problem, if you set up this balance sheet, then it allows you to work the problems fairly easily. Okay, so here's the questions. For A, what is the total debt? Well, the total debt is the short-term debt plus the long-term debt. Okay, so the short-term debt is 150,000. Okay, so here they've gone back, and I know it's a little confusing. They're just including the notes payable as the debt. So you can do it either way. You could have answered this question 2 ways. In my opinion, it would still be right. For their total debt, you could have taken the current liabilities plus the long-term debt. That would give you $1 million. Or what they're doing here is they're just using the stricter definition, and they're just taking the notes payable plus the long-term debt.
Like, how will you do it on tests? Like, will you be able to, will you just go one way or another, or are you going to do both?
Remind me on Monday. I want to look at the exam and see how it's, and see if there's any questions specifically like that. And I can tell
Yeah,
you. for
because
sure.
it could leave a lot of room for error.
Yeah, so I'll tell you for sure. Because to be honest with you, we, I don't know if you have talked to students who have taken my class before or what have you, but what we have done as a department, we have gone to departmental exams. So we used to each make up our own exams. And for years, I like to have, I personally like to give problems because you can give partial credit. But the department, they've done this in accounting. You've all had accounting, so you know that you were taking the departmental exams. So we've done that for Finance 302. So just to be transparent with you, that's why I've been saying all semester, it's a multiple choice test, and you really need to study because a lot of these questions are confusing. And so that's why, and that's another reason why I'm going to have a really detailed review session for you. So I need to look at the exam and see how this is being calculated. I'll tell you on Monday. But the problem with the multiple choice exams, in my opinion, is you can't give partial credit. But on the bright side, you have the answer there in front of you. So it's a little bit easier to get the answer. So,
Yeah.
so anyway, for the first, from now on, Finance 302, all the professors are giving the same exams, and and they're departmental exams. So that's why if you were surprised that I was giving a multiple choice exam, if you've talked to students who've had me in the past, that's why I am in this class. So anyway, getting back to the debt ratio, I will let you know for sure how to calculate that on Monday, whether you're just going to use notes payable plus long-term debt to figure out the debt, or you're going to use current liabilities. But anyway, getting back to this, the total debt is 900,000. Okay, and then for B, we are given, let's see, B is asking, what is the company's total liabilities and equities as it appears on the balance sheet? Okay, so the total liabilities and owner's equity is just the bottom line here, the 2,500,000. So they gave us the number for the total common equity here. And so remember from the quiz, what two things make up what common equity?
Retained earnings and then the common stock.
Yeah, so the common stock plus retained earnings. All right, and then common equity. Because a couple of you emailed me that you couldn't find the formula for common equity. Well, there's really no formula. You just have to look at the balance sheet. The total common equity is the common stock plus the retained earnings. Okay, and then here they're asking for current assets. So the current assets are 500,000. Total assets minus the net plant and equipment. What are the current liabilities? 250. The 100 plus the 150. This was our plug number, remember? So by elimination, if you just start with the 2,500,000 and subtract everything else out, that'll give you your current liabilities. Yeah, the solutions. Yeah, I will. I'll post these so you can review them. They'll be posted tomorrow. What else here? Okay, what is the accounts payable and accruals? You just had to, that was our plug number. That's 100,000 right there. Okay, and then what is the net working capital? Okay, the net working capital is current assets minus current liabilities. So that's 500,000 minus 250. The net operating working capital doesn't include it's only the working capital from operations. So it does not include the notes payable because that's a financing liability. So it is, so basically the way you calculate that is you're going to exclude the notes payable. So it's going to be current assets. Oh, and then if there's any excess cash, you subtract out the excess cash, but there wasn't any here. So it's current assets minus current liabilities minus the notes payable. So the net operating working capital is 400,000. Okay. And then for H, they're asking, what is the explanation of the difference? And what's the difference is the 150 of notes payable. All right. Okay. And then for number 2, we went over this on Monday, but what you had to do was you take the net income. They're asking you what the interest is. And so we know what EBIT is. We know the net income and we know the tax rate. And so if you take, you just have to, it's like completing a puzzle here. If you take the 15 million of net income and you divide that by 1 minus the tax rate, that gives you your earnings before taxes. So then you just take the difference here and that allows you to find your interest of 800,000. So I wouldn't worry about this on the exam. Definitely, I would go over number 1 because there's several questions about the balance sheet, and this will give you an idea, better idea of, you know, what's on the balance sheet and what the numbers mean. So definitely look at problem 1. You can skip problem 2 when you're studying for the exam. And then number 3, oh, 3 we didn't have to do. Okay. Okay, this one is important. There's a problem on retained earnings on the exam. And so remember this formula here from Monday. Your retained earnings from the prior, so this is backwards here. The retained earnings for the current year or the year end equals the retained earnings for the prior year, or the beginning of the year, plus your net income minus any dividends paid. So think about this. You look at your prior year retained earnings or the beginning year retained earnings. You add any net income that you made to it and you subtract any dividends that you paid. That gives you your year-end retained earnings. So in this problem, they've given us the beginning year retained earnings of 784. They told us that they made 75 million in net income. And then they've given us our year-end retained earnings. And they're asking us to solve for the dividends. So you just solve for that. And it's 34 million.
I think I meant like accidentally did number 5 instead of number 4 because number 5, the same answer I had for 4 apparently. So.
Oh, okay. It's 4 and 5 is assigned, but so just understand, make sure you know that, write this formula down on your formula sheet and make sure you understand the relationship among all.
Oh yeah, I got it. Thank you.
Okay.
Like our formula sheet, so we would write it out like in words, or like you would have to use those symbols and stuff?
You can write it out in words.
Okay.
That's fine. I mean, the formula sheet is formulas only, but you can write out what they are.
So it was like no steps or anything.
Right.
or Solve a problem.
No steps to solve a problem, just the formulas. And bring a Scantron, obviously. Okay, market value added. That is the formula here. It's the price of the stock times the number of shares outstanding minus the book value of the common equity. You get that from the balance sheet. And so here you're solving for the number of shares. So we're solving for X here. You're not going to have a problem like this on the test, but just make sure you understand. I mean, write down this formula, make sure you understand what the market value added means and how you would calculate it. Okay, and then let's see, 7, 9, and 14. Okay, let's go to 7. Okay, this is the economic value added. So write down this formula. The economic value added is basically saying, all they're doing here is they're saying, okay, after we paid our investors, what we owed them. So let's say you have stocks and bonds and you pay your investors a return on their stock and a percentage interest on the bonds. After you've paid off all your investors, did you still make money? Is what you're doing still adding value to the firm? That's all economic value is. So it's the earnings before interest and taxes times 1 minus the tax rate minus, this is how much capital they invested, times the 8% that they had to pay their investors. So they earned this much. This is what was invested. And so this is what was added. So they did add $1 million in economic value to the firm. All right, that's 7. And then 9. Oh, okay, 9 was multiple choice, basically. 9 is just saying, which of the following actions are more likely to directly increase cash as shown on the firm's balance sheet? Explain and state the assumptions that underlie your answers. All right, so number A is the correct answer. So A is a firm issues $4 million in common stock. Okay, so that is going to that's going to increase the cash on the balance sheet, because if a firm issues if they sell $4 million in common stock, okay, then on the owner's equity side, that's going to increase by 4 million. On the liabilities and owner's equity side, it'll increase by 4 million. But where's the money going? It's cash. So the cash is going to increase by 4 million. So A is the answer. B is it buys new plant and equipment. Obviously, that's going to decrease cash. C reports a large loss for the year. C will probably decrease their cash. The only way it wouldn't is if they got a tax refund. And then D, they increase their dividends paid. If they increase their dividends, that's going to decrease their cash. All right, so A is the answer. A is the only thing there that would increase the cash. Okay, and then 14, A and B was you're supposed to calculate the free cash flow. So let's take a look at this. So the first thing, in order to calculate the free cash flow, you had to calculate the net operating working capital for both years for this company. They give you the balance sheet and the income statement. So it's total current assets minus excess cash minus current liabilities minus notes payable. So you should have gotten your net operating working capital for 2020 is 42,000. For 2021, the net operating working capital is 50,000. We're going to take the difference of these two numbers to plug that into this formula here for the free cash flow. So here's the free cash flow. So make sure you write both of these formulas down. And this free cash flow formula, you may have to figure out free cash flow on the test, or you may just have some conceptual questions, but you need to be able to understand what's going on here in the formula to answer any conceptual questions. So the free cash flow is going to be the earnings before interest and taxes plus 1 minus the tax rate, okay, plus depreciation. So you get all this information from the income statement, okay, minus their capital expenditures. The capital expenditures, it's the difference in their net fixed assets, how much they purchased, how much they increased in net fixed assets, plus depreciation. So if the balance sheet shows you the net fixed assets, you take the difference and you add depreciation. If the balance sheet shows you the gross fixed assets, you don't have to worry about adding back depreciation because they haven't taken it out yet. You just take the difference. So if it's gross fixed assets, you just take the difference between the 2 years. If it's net fixed assets, you take the difference between the 2 years and add back depreciation. So in this case, they gave us the net fixed assets, and the net fixed assets changed by $2,000. And then the depreciation we got from the income statement was $6,000. So the capital expenditures, that's the change. That's how much they purchased this year, is $8,000. That's where you get this number.
Okay, so Even like, yeah, like, so even if the change is negative, it would still be like added to the, like capital expenditures is positive, right? Okay, then I that's how I messed up in the question.
Well, if it were negative, yeah, you would still add the capital. You would add the depreciation.
Hmm.
Let's say they decrease their capital expenditures. Let's say that, I'm sorry, let's say they decrease their fixed assets. Let's say let's say the fixed assets went down by 2,000. Okay, well, then you would still have to add the 6,000 to that. So it would end up being 4,000. All right, so that's how you, so just to repeat here, how you get these numbers. EBIT, that's in the income statement, times 1 minus the tax rate, that's given, plus depreciation, that's from the income statement, minus your capital expenditures, that's the change in the net fixed assets, plus depreciation, plus the change in net operating working capital. And so if you see right here, they spent an additional $8,220 in net operating working capital from 2020 to 2021. So what are we actually doing here? Well, we're looking at their earnings, after-tax earnings. We're adding back depreciation because that's a non-cash expense. And then we're subtracting out all the money that they spent. That gives us our free cash flows. The cash flows, the money that's available to investors. So that's all that's going on here. Okay, any questions on the chapter 3 homework? All right, I'll post these solutions so you can use them to study for the exam. I'll post them starting tomorrow. All right, let's go to chapter 4. Okay, so the chapter 4 homework is questions 1, 2, and 6. Okay, what are the, for question 1, what are the 3 main groups of, okay, the 3 main groups of people who look at these ratios: credit analysts, stock analysts, and managers. What's the primary emphasis of each group, and what emphasis would affect the ratios that they focus on? Right, so let's take a look at that. All right, so a credit analyst is obviously going to be more interested in the debt ratios, times interest earned. Those are the profitability ratios. If you're an investor interested in buying bonds, you're going to be interested in debt ratio and time interest earned. I think as an investor, you're pretty much interested in all the ratios. As a stockholder, you want to look at the big picture. And of course, managers want to look at all the ratios too. They want to see the big picture as well. All right. And number 2, why would inventory turnover be important to someone analyzing a grocery store chain compared to an insurance company? Okay, well, obviously, because an insurance company really wouldn't have any inventory, but a grocery store has a lot of inventory. So if you're in an industry that has a lot of inventory, then you're going to be interested in the inventory turnover, and particularly a grocery store, because a lot of that inventory is perishable. So you don't want to have a bunch of excess inventory of produce, dairy, meat, because it could all go bad. So, the more inventory that an industry has, then the inventory turnover ratio becomes more important. And if the inventory is something that is going to go bad in time, if it's perishable, even more emphasis on inventory turnover ratio there. Okay, and then number 6, if a firm's return on equity is low and management wants to improve it, explain how using more debt might help. All right, so look at the formula for return on equity. Make sure that you understand this concept. So return on equity is net income over total common equity. So you go to so you look at the net income from the balance sheet. I'm sorry, you look at the bottom line of the income statement, the net income number, and then you look at the total common equity on the balance sheet. So if their return on equity is low, think of the numerator and the denominator. They've net income divided by total common equity. Well, they can either, get rid of some equity, retained earnings, or sell off some stock, or that would reduce the denominator, but it would make more sense to increase the numerator, right? So if you increase the net income, that's going to increase the return on equity. So how would using more debt help? Well, what you can do is you could finance a new project and finance it exclusively with bonds or getting loans. So if you finance a new project with debt, that increases the net income. That's going to increase your net income, increases the numerator, but your total common equity will stay the same. So that's how using debt can increase the return on equity, because debt is being used to finance a new project. And if it increases the profitability, the net income goes up, but the owner's equity number, the denominator, stays the same, and that'll increase the return on equity. Of course, the debt holders don't really like that, though, if you think about it, because they would be taking all the risk on the project, and yet the stockholders are getting the benefit with this increased return on equity. So that's what they're getting at with that question. Okay, let's go to the problems. Okay, it's 1, 3, 5, and 23. Oh, because it's the, yeah, because it is the DuPont. Yeah. So it's 1, 5, and 23. Okay, so 5 is day sales outstanding. So on the exam, there's just some straightforward questions where you have to calculate some ratios. I'm not going to give you questions like this. Well, it's like I said, it's I'll have to say we aren't, because it's a departmental exam, but we're not giving you questions where you have to, calculate the accounts receivable and do all this algebra. You'll have a straightforward question like, what is the day sales outstanding? But anyway, this is how you calculated this. So they gave you the day sales outstanding, and they gave you the day sales outstanding, and you had to calculate from there, calculate the accounts receivable. So the day sales outstanding was accounts receivable divided by sales over 365. And when you you just divide this, multiply this by this number, and you end up with accounts receivable at 230,000. But what does the day sales outstanding mean? That means that it's taking 23 days to calculate for them to collect their bills from their creditors. So I mean, from their customers. So day sales outstanding means that once they make a sale, it takes 23 days for them to get paid by their customers. All right, number 5. Okay, again, this one, you're not gonna have a problem like this. Let's just go over what the PE ratio means. You had to solve, you had to find the price of the stock using the market to book ratio. And then once you found the stock, then you could find the PE ratio. But let's just look at the PE ratio and see what it means. The PE ratio is the price to earnings ratio. That's the price of the stock, the price per share, the price of the stock per share divided by the earnings per share. So the earnings per share, the way you calculate that, that's the net income divided by the number of shares outstanding. So price per share divided by earnings per share, we get a PE ratio, price to earnings, of 24.57 times. That means that investors are willing to pay 24 times earnings for the stock. So with this PE ratio, when you look at a range, if you look at a company and all their competitors, the companies that have the higher PE ratios are the better companies to invest in, because it shows that people are willing to pay more for that stock because they think it's a better investment. They're willing to pay, in this case, 24 times. So if you had a situation where another competitor was 20, another one was 19, this stock would be viewed as a better company because investors are willing to pay more for it. They think it's a better run company, more profitable, what have you. So this is a times, 24.57 times means that investors are willing to pay 24 times earnings for this stock. Now, if you had an outlier, if you had another company within this industry, let's say it had a PE ratio of 60 times. So if I was looking at that as an investor, I would say, okay, well, one company's got 19, one has 20, one has 24, another one has 60. Are they really that much better? Or has the stock just had a huge run up in price? So if you look at this formula, the price per share divided by earnings per share, if you see a company that has a really, really high PE ratio, it could mean that the price has just had this huge run up for whatever reason. News, just because people are really excited about the company, excited about the stock. In other words, it could be overvalued. So if you have you have to be a little bit cautious with companies that have really, really high PE ratios, because it could mean that it's a good company, but the PE ratios, the price of the stock may come down. It may have had too much of a run up too fast. All right, so that's all I wanted to mention about number 5. Okay, let's skip to 23. So for 23, just make sure you can calculate these ratios and you understand, what the meaning of these ratios are. And on the exam, you'll be calculating a few ratios, but you'll have your formula sheet, so you don't have to memorize them. All right, so for part A, you just have to calculate the ratios. So here's the formulas, here's the numbers. So if you missed any of these, you can go back and look and see how they got these numbers. So this is just current assets divided by current liabilities. Okay, 1.98 times. So they're a little under the industry average. The quick ratio, they're subtracting out inventory. Okay, day sales outstanding, not too good there. They're taking them more than twice the time to collect from their customers. Inventory turnover, that's cost of goods sold divided by inventories. Sometimes, now here's another kind of confusing situation. They're using cost of goods sold. Some books use sales divided by inventories. So let me look at the exam. Let me make a note on that. So I don't want there to be any confusion on the exam. So I'm going to look at the inventory turnover, and the other one was the debt ratio. Okay, because just to repeat what I was saying, sometimes it's sales divided by inventories versus cost of goods sold. So I'll make sure to give you some clarification on Monday on that regarding the exam. All right, and then total asset turnover, sales over total assets. Shows how efficient they are in using their total assets to generate sales. So they're doing pretty well there. The profit margin, or net profit margin, net income over sales. Return on assets, how much net income are they able to generate? Total assets. Return on equity, net income divided by common equity. So that's stock plus retained earnings. Return on invested capital, that is the earnings before interest and taxes times 1 minus the tax rate divided by the total invested capital. That is that's your notes. That's the notes payable plus the long-term debt plus owner's equity. Okay. And then times interest earned, EBIT over interest. Here's the debt ratio. And in this, they're using just the notes payable. It's notes payable plus long-term debt divided by notes payable plus long-term debt plus owner's equity. And here's the PE ratio. Here's the market to book, the price of the stock divided by the book value of the stock. You get that from the balance sheet. Here's the price per share divided by the earnings per share. There's the PE ratio. So they're a little low, you see, they're a little under the industry average on the PE ratio. And then don't worry about this last one. So if you just make sure, like I said, that you can calculate these ratios and understand them if there's any conceptual questions on these ratios. Right. Are there any questions about the homework or the quiz? All right. So all you need to do then is start reviewing. Don't wait till the last minute. I really want you all to do well on this exam. That's why I've pushed back the date as far as I have. So you've got a whole week to study. By tomorrow, I'll have some additional information on the study guide to give you a little bit more direction on what to study. And then on Monday, all of Monday is going to be devoted to just review for the exam. That's on Wednesday. Okay, take care, everybody, and I'll see you in class on Monday.